Welcome to today's webinar. This is Josh. I'm going to be your presenter today. Basically, the document has, well, let me go back to that. Let me bring it up on the page here. So, loans and mortgages. So, now that here it is. So, right here in the document, I'm going to show it to you. You can't print it here, but you can look at it. There are 4 methods for how we can track and record loans or mortgage payments in Church Windows Accounting, okay? And I'm going to try to go through each of them, as thoroughly as I can. Some are more complex than others, and basically that's where we're going to start, is we're going to start on more methods 1 and 2, okay? So right here is where the line's drawn on that is above 3, and so anything above it is our first 2 methods on that, okay? Basically, method 1 and method 2 are simply talking about entering bills, paying bills for the amount of your payment for your loan or your mortgage, okay? Basically, they're just an enter bills, pay bills process. The only difference between method 1 and method 2 is one of them just records the total amount of the payment, combining interest and principal together into one expense, and then posting the payment. Okay, it's the simplest, absolutely simplest method possible for recording a loan payment, okay? Not treating the payment on the loan any differently than you would any other vendor or payee payment, bill and payment, okay? Method 2, the only difference between it and method 1 is you are choosing to have 2 different expense accounts, one for the principal amount of the monthly payment and one for the interest amount that's being paid, okay? So basically, you're still entering the bill, you're just splitting it over 2 expense accounts and then posting the payment. So when we decide that we're going to do that, okay, let's go into accounting, and I've gone ahead and set up some accounts for these already, all right? I would go into, and we're not talking about recording the loan or mortgage payment on the balance sheet at all. All we're doing is showing it under the treasurer's report, okay? So when I go into, say, enter bills, okay, I would choose my construction loan vendor, Hometown Bank. That's who I'm paying for this, okay? And so I would choose my vendor that I'm paying. I would enter any optional comments on that. Down here, I would choose the expense account that I'm paying. So here, notice I've got 2 accounts. One that says construction loan principal and one that says construction loan interest. Well, option 1, there isn't a separation. It would be just one account. I would just call it construction loan payment, or expense. And I would just pull in the full amount, put in the full amount here. Oh, come on, Josh, you can do this. Loan, come on, Josh, you can do it, buddy. Construction loan principal, say, and we would just do the full $1,000 of our monthly payment on that, add it to my batch and pay it, okay? That's essentially what it's detailing down at option number 1 at the bottom of page 1 there on the document. Just shows the, Hometown Bank shows the 1 expense account. I now just post the bill and I record the payment just like I would normally. Okay, nothing terribly complex about it. Okay. Option number 2, method number 2 there on the top of page 2 now talks about splitting that. Okay, so here I am, if I'm at my enter bills again, all right, I now come down to my loan expense, my principal expense, and I put in the amount of, say, principal that I'm paying each month for that month, right? So then I now click the plus sign. Everything about it's still the same, choosing my date, entering my vendor, entering any desired comments. Now I would choose my construction loan interest expense, and then I would put in the amount of the interest that I'm paying in the month for that, okay? So now when I click done, add to batch, okay, I go show running balance here. It now shows how much I've charged for each one of my expense accounts, one for interest, one for principal, put $1,000 into my construction loan liability to pay Hometown Bank, and now simply I post the payment, pay it just like I would normally, whether I'm going online to pay it with them or I'm going to print a check for them, or however I'm going to actually make the payment with the bank on that mortgage or loan. Okay, so again, I can kind of move through this first 2 methods pretty quickly because they, like I said, they really only just affect the treasurer's report and that's it. Treasurer's report and cash, okay? Yeah, I show a bill and a payment to my, hometown bank liability or vendor account that I have set up for them to record, the vendor that I've paid throughout the year, okay, for that. But again, it's the simplest method that we have. Whether you're choosing to show the expense for the loan payment or mortgage payment on a single expense account, or whether you're wanting to split up interest and principal each month and still then splitting it up and then posting the single payment. Okay, so that's options number 1 and 2, methods number 1 and 2. All right, those are, like I said at the very beginning, it's all a matter of where and how you want it to report and the level of complexity that you want to get into in order that's going to help you decide which one. And folks, they're just different. It's how each church wants it to report on it differently. Okay. Do we want to see the principal amount of the loan or mortgage that we owe, how much the remaining principal on that is still owed at any time on our balance sheet? That really is the question of which one of these methods you choose. If the church doesn't care about seeing the amount of principal that's outstanding on the loan on the balance sheet each month, then use methods 1 or 2 here. Okay. It's that simple. This does not show on the balance sheet at all, other than it's reducing the fund balance and reducing the amount of cash on our balance sheet that we're paying, just like any other vendor or payee. Okay? All right. So that's just the repayment. All right. If I want to now, when I take the loan out on the bank, if I'm using methods 1 or 2, we're just going to delete this batch and come in and enter it. If I want to get that money, when I get the loan out at the bank, when I take that out, I still have to get that on my books. Now, the document talks about on page 1 there about methods 1 and 2 use the initial entry of the loan as a debit to an asset, increasing the bank balance, of course, and a credit to income. I have mixed thoughts on that, okay? So is it really income? It's a loan. If the church wants to see it on the treasurer's report, then by all means, go to enter income, report it as a credit to a loan income account and a debit to the bank. Okay? If you don't want to see it on the treasurer's report as income, which again, a loan isn't income. It's just money we're borrowing, right? Okay? So if the church doesn't want to see it on the treasurer's report as a balance, as an income on the treasurer's report, then simply go up to transactions here in the upper left, right across the top to other, and say journal entry or adjust asset, okay? So then your transaction is, all right, I'm taking out a $10,000 construction loan today. I just need to get it into my Huntington Bank checking account, okay? So I do there, I put in $10,000 in my checking account. Debit increases the balance, of course. And then here I would say choose something like my general fund, okay, general operating fund. Credit that amount for $10,000, okay? That then gets that money in the fund and in the bank for me to use, okay, or whatever fund you're doing. But what this does is by posting it directly to the 300 fund balance account, and again, just by way of reminder, over here on the left, 310-100, that's a fund. That's not an income or an expense, okay? Again, transactions that post to funds, while rare, are necessary from time to time. Maybe we consider that this one of those times, okay? So all I'm doing is just getting it added into my balance sheet and into my cash account, so into the fund and the asset equally, so I can use it to spend out of my general fund or my building fund or wherever the money's going to be spent for that construction loan, okay? Bypassing the treasurer's report. Shows up on my fund activity report, but doesn't hit my treasurer's report. So it's your choice, okay? So what I tell folks on my webinars is, while the documents show one thing, I might have a different opinion about it, and I like to explain to folks why my opinion might differ from this. So you decide, do you credit income account when you're putting the loan money in your accounts to get it on your books, or do you credit the fund balance directly and then debit the bank to get the money on there, okay? So now if I add that transaction to my batch, I'm not going to post it, and I do show running balance again, it's showing $10,000 increasing or going into my Huntington Bank checking account, and my general operating fund is increased by the 10,000. Okay. So again, that's just getting the amount of loan on our books. All right. Now, when you're using methods 1 or 2, all right. All right. So we're almost halfway through our event here, and I've got to go through really probably the more complex part of this. So methods 3 and 4, and this is one that generally tends, well, wish I could say which one was more popular than the other. I just don't know. I can't say. Methods 3 and 4 are popular. Why? Because again, we want to see the principal amount that we still owe on the loan on our balance sheet at any time. So what that requires, and folks, this document does show each one of the accounts that are necessary to record these. It details the transactions that they're going to be posting to go through and record these entries of these monies and the subsequent bill and payments or payments for those. All of the transactions that are required, essentially, to get on the books in and out. Okay. So methods 3 and 4 require then that we set up a liability account on our books to show how much we still owe on the loan at any given time. So what I've done is already gone in and added that in addition to the expense accounts, that I set up for my construction loan. But right down here, we see in my chart of accounts on the left, right here, 290-200 construction loan liability. Okay. That is the account that's going to receive the amount of that loan. Okay. So if I click on that account and go to the balance tab, got no money in it. All right. So I'm now borrowing the money from the bank. I need to get that money on my books. So same thing. I'm either going to go to journal entry up here, do a journal entry transaction, or I like to remind folks, if I go to enter income, I can choose the bank account that I'm adding it into. Let's say I'm borrowing this money today, construction loan deposit. Okay. Then I come down here and notice it says income/expense/liability account. Okay. So here I can choose my construction loan liability 290-200 construction loan liability, put in my $10,000 that I'm borrowing for this construction project, and then click Done Add to Batch, and I now click Show Running Balance. Looky there, construction loan starts with 0, adds in 10,000, current balance is 10. My checking account is now higher by $10,000. Okay, so that's how I will get the loan on my books when they make the deposit into my account. Okay, at that point, I'm just going to go ahead and expense it out of my general fund or my building fund or wherever I would, and whatever the effect is on that fund doesn't matter. I just don't. I have a long-term liability, and I don't have that money in the fund to use for other things. Okay, so the fund being expensed or lower by $10,000 is an accurate picture because I owe the $10,000 now. Okay, so now I would go ahead and post that. Okay, I'm not going to print it. Okay, so now when I go in and I say, look at my balance sheet for August 2025, and I go to print, here is now my balance sheet. Here is my construction loan liability with the now year-to-date balance of $10,000 on it. Okay. And yes, like I said, now I'm going to go in and I'm just going to go ahead and pay things from my building fund or whatever's going to pay for that. And then as I repay this loan liability, this balance now will reduce in this account under this liability. So that's what we're going to talk about now. How do I now subsequently record these repayment of this or the payment for this loan liability each and every month? So that's a very good and warranted question. So if we now flip over to page 2 and talk about method 3, okay, again, we're back to the similar type scenario that we had for 1 and 2 in the sense that are we expensing the interest only on the treasurer's report, or are we expensing both interest and principal on the treasurer's report each month? And I meant to say earlier is the document, folks, does also show pros and cons, or talk about pros and cons that occur for each one of these scenarios, okay? So if I'm using method 3, I'm only expensing the interest, okay? So if I would go into enter bills again, I would choose enter my date, I would put in my construction loan liability account, I would enter my comments, I would choose my interest, my construction loan interest expense, and I would put in the amount of the interest that I'm paying, okay? Done, add to batch. Similarly then, I click show running balance. We now notice here under show running balance that my construction loan is current balance is 10,000, adding in 210. It now then shows an adjusted balance of 10,200. I've added the amount of interest into that liability account, okay? So now, when I now then, if I were to post this or post and pay these bills, okay, I'm not going to print it. Here I am, okay. I've entered a bill for $10,000 or for $210, so the amount to pay is only going to be reflecting the amount of my bill. But I want to pay an additional $790 of principal. So I'm going to just go click here where it says amount to pay, and I'm going to change that 210 here to 1,000 because that's how much I'm actually paying. The interest that I've added and the amount of principal that I'm paying down. Okay, and then I would choose whatever payment method I'm paying them. Notice when I do show running balance that my construction loan liability balance is now lower by $790 because it's a self-adjusting account. Okay, I am not seeing the interest or the principal that I'm paying each month, only the interest, because that's how my church chooses to handle it. Okay. That's again one of the main differences here of the level of complexity. So this is a very popular method because again, the interest is showing up on the treasurer's report. The loan liability is being a self-adjusting by the amount of principal. It's just being reduced and it's coming out of cash for the full amount of the payment. Okay. But some folks go, well, I believe that the actual amount of principal that I'm paying each month is an expense to the church, and I do want to see that principal amount showing up on my treasurer's report each month, okay? Well, that then changes things, and we're now moving on to option number 4, okay? So let's go back into transactions. Let me get rid of that bill that I posted for the amount of that 210 on August 12th. Where is it, Josh? August 12th. Is it August 12th? All right, here we are. There it is. 210, we're going to reverse that. Okay, so we're going to get rid of that, okay? So that's now reversed. We're back to square one where we started. Okay, so now my church says, my financial secretary or my treasurer or my finance committee says, hey, we want to see both the interest and the principal expensed each month on our treasurer's report. So I go back into enter bills just like I did, and I'm going to choose my construction loan liability again. There it is. So here I'm going to choose my interest expense, type today, interest, construction loan interest, putting in my $210, okay, clicking the plus sign. Now coming down here and choosing principal, there's my construction loan principal, putting in my $790 for my combined total of my payment. So this is really one of the most important parts about understanding what's happening here, and what you need to do is all I've done when I add this bill to the batch is now when I go up to show running balance, now notice that my construction loan liability shows an adjusted balance or current balance of $10,000. Adding in 1,000, it's now showing $11,000. Okay, so now if I were to do post and pay these bills, okay, not going to print the bill. So here the amount of my payment is correct. And I have done what I wanted to do by showing that it's expensed on both interest and principal on the balance sheet or on my treasurer's report. But if I go to show running balance here in the upper right corner, look at what has happened to my look what's happening to the balance in my construction loan liability. The $11,000 is reduced by 1,000, but I'm now down to where I started the day. That's still, that loan liability balance does not show the amount of principal that I've paid. And that's where that additional final transaction, folks, on the bottom of page 3 about posting the journal entry is vitally important. It's the only way to do it. Okay, so if I post this now, yeah, it's fine. It's just warning me about that. It's fine. Okay, so I'm not printing it, but my loan construction liability balance is not changed. I have to now go in and post a third transaction in addition to the bill and the payment that I posted. So I'm going to go up to other here in journal entry transaction. And I'm going to date this. Today's date's fine because I did that. You know, I can put in here, you know, adjustment for loan principal. Okay. And then I come down here and I choose my loan or construction loan liability balance. I'm going to debit that $790. Okay. And I'm now I have to choose, what am I going to credit? Okay. I don't want to credit the expense account because it defeats the purpose of my principal expense. So most likely, again, I'm probably just going to credit it back to my general fund or my building fund, whichever fund the money was originally paid out of. So probably I'm going to put it back into my building fund because that's where those expenses are linked. Okay. So now I would put the credit amount in there of 790. Okay. And now click Done, Add to Batch. And now when we click Show Running Balance, we now show that the construction loan liability is now reduced by the amount of principal that I've paid. Okay. So again, folks, different levels of complexity. But now I would post this, and now my balance sheet would be correct. All right. But that is the main difference between methods 3 and 4 is, again, separating principal and interest or not. And if you do, and you want to see them, then that third and final journal entry transaction is required in order to show that reduction in the amount of principal that you've paid in that liability account on your balance sheet. Okay? So that then warrants one final topic here to cover that's really not covered on the document per se, but I feel that it's important because we've been dealing with a pretty simple construction loan in this particular case. Mortgages, folks, are handled basically the same exact way. You decide which way you want to handle your mortgage, okay? The main difference between a mortgage and maybe a simple construction loan like this is, frankly, their volume, okay? We're talking about a $10,000 construction loan today, but a mortgage might be hundreds of thousands of dollars, if not millions of dollars in some cases, okay? Well, when we're dealing with mortgages, oftentimes it may be helpful to use and set up fixed asset accounts on your balance sheet to absorb the amount of the loan or the mortgage that the church owes. So like in our case, we've got a $225,000, $500 mortgage liability on our balance sheet, okay? Well, as I spend that money for whatever that, well, in this case, whatever the mortgage is still owed on it, I've now got a mortgage liability set up because if I have that liability, it's not down in a fund somewhere. So that $225,000 would have to be showing up somewhere down here, typically as a negative value. Why? Because I have less equity. Okay. So it's oftentimes, notice here we've got land and building up here, furniture and equipments equaling $1.5 million, $225,500 loan liability. We also have a net fixed asset fund down here at the bottom for the difference between the two. $1,280,550 or $500. Okay. So if you choose to record both the principal and the interest on like an option or method number 4 for your mortgage, all right, then that final journal entry you post will debit this mortgage payable or mortgage liability balance, and it'll credit the net fixed asset fund balance. Okay, not the general fund or building fund, because it's just more equity. All right. You're basically showing we owe less on the balance and we own more equity in the property, okay? So that's a real fundamental difference that I want to recommend. Honestly, if you're taking out a simple loan like a construction loan like the one that we're using here for $10,000, probably not a good idea and probably not unnecessary to set up fixed assets on your chart of accounts. But if you're using or opting for methods 3 or 4 on your balance sheet for the repayment options, and it's a sizable amount of the mortgage on that, fixed assets could really help make your balance sheet look much better, right? Because I don't have a fund that's reporting a negative balance for the amount of that loan or mortgage that I owe, and to the tune of sometimes hundreds, if not millions of dollars, hundreds of thousands and millions of dollars. So the fixed asset fund combined with the assets, right? Fixed assets are the appraised or estimated value of the church building grounds property. The loan is the amount we owe. It's its own little mini balance sheet, right? Total fixed assets at the top minus the loan liability equals the net fixed asset fund. And then that accounts, those liabilities get adjusted. The liability gets adjusted lower and the net fixed asset gets built, gets fixed. The balance goes up. When the loan or mortgage liability balance goes back to zero again, my fixed assets at the top and my net fixed asset fund have the same balance, okay? So that's the only thing I wanted to add about that at the end, because fixed assets, while helpful, are not always necessary or warranted, but certainly could be or would be when you're talking about a sizable mortgage, okay? All right, folks, it is 1 minute till 12 here. Probably going to switch over really quickly. So that is where I'm going to leave the topic for today.